A hawkish Fed, Iran-driven oil stress, and 30-year yields at 2007 highs are reshaping this market. Stay with us to find out if the sell-off continues. In our indicator pane, we see what's the problem. So first of all, our smart money indicator detected a bearish impulse. This is a bad sign. But even worse is the rising risk. We have now the risk indicator flashing yellow on the short, mid and long term. And all this leads to a bearish turnaround candle with very bad statistics. About 72% bearish, so we could see lower lows in the coming weeks. And all in all, we expect a very choppy market. Now let's have a look at the smart money indicator. Basically, we are negative on the weekly and on the daily time frame. And yesterday we have even seen a bearish impulse on the daily, which is, let's say, the fifth or the sixth bearish impulse in a short period of time. So this is somehow serious. But let's have a closer look. And here we see already that the market is weak. We have closed below the most dominant moving average that acted as support during the epic spring rally. And we reached the last accumulation zone around 730, which was formed back in June over here. That could be a good level for a short rebound. However, the bearish picture is supposed to continue, and combined with the bearish impulse, the distribution that we have seen over a long period of time, and the generally very weak seasonality opens up the possibility to a pullback to the 200-day moving average, or even that's the 100, sorry, or the 200-day moving average. And we are talking about a level of 7,000 in the SPY. Well, the weekly time frame doesn't look any better, actually. You can see the very bad seasonality which lays ahead of us until mid of September, maybe even longer, if we consider that the midterm elections are only taking place in November. And typically from September to October we could see a sideways market after a heavy sell-off. Notably, our risk indicator has turned yellow recently and is now flashing warning signals for other breakouts, even on the mid to long term. Things have shifted dramatically. Let's have a closer look. As you can see, the risk regimes did rise earlier and are now again in the yellow level. Typically, when you have rising risk levels, market at some point will start going sideways, and if it turns red, they take a dive. And this dive will only stop once the risk decreases. This indicator is very powerful and has worked very well over the past. You can see the regimes, and the regimes are a good thing, because when you enter a regime, you have a statistical edge that you will stay in that regime, or you even know what's likely to happen next. So after we enter yellow regime, it's very likely that we enter a red one. And after a red one, at some point, we have de-risking, and with entering a de-risking regime at the bottom of the markets, they typically tend to rise. That wasn't quite true over here, but it was very true over here, where we started this epic bull rally. However, back to today. Risk is rising. There is no end in sight. Of course, we could have a hefty bear market rally any day, but that doesn't take the risk out of the system until it's really solved by the Fed or addressed by geopolitical actions, de-escalation in the Far East, for example. Right now, doesn't look like this is going to happen. And if you want to know what is causing the risk, you can have a look here. Right now, one of the main risk is the Nasdaq volatility, which is unusually high. The whole market volatility is comparable low. Well, it's elevated. Let's see how that played out in the past. A couple of days ago, that was still green. You could even compare it to a day over here, or let's say, yeah, super green. And what about here? Red face. That's how it looks when the market gets into panic. So we have three main risk contributors, and I'm monitoring all those indicators at the same time, yielding this compound risk indicator. Fast forward to today. What are the main contributors? We have yield problems, we have liquidity problems, and we have credit risk problems rising. For now it's still small, but if the trend continues, it's going to be a problem for the credit market soon. And this is displayed also in the MOVE index, which is the volatility, so to say, the VIX of the bond markets, which is on the rise again. Now let's have a look on the big elephant in the room. Actually, we have two elephants. One is, of course, the oil price, which is driving inflation. And we can see that even on a daily basis, oil keeps staying risky. We are in an uptrend. We have seen a distribution earlier, but the fundamentals, they are heavily weighing on the oil price. And with every day the Strait of Hormuz remains closed, and with every burning oil facility, oil refinery in Russia or in the Far East, this problem is going to weigh heavily on the global economy. So with current US inventory levels being at the lowest percentile since years, and with a growing demand outlook, the green line here, you can treat whatever you want, but the fundamentals should make oil go higher. And that's what oil did, actually, since early July, with an accumulation over here and then an uptrend. So this is one big topic, and the oil price is fueling inflation. The Fed yesterday said that inflation is under control, but this was at the time where the last reading was around here, beginning of June, beginning of July, end of June. And since then, the oil price has changed dramatically. Let's have a look at inflation. It seems stable. However, if we analyze the components, we see that the impact can already be seen. So energy is up 16%. Transportation is, depending on oil prices, up 6%. Other goods and services are up 4%. So food and beverages are only up 2.8%. Well, I think consumers all over the world, they feel inflation. So and they even spend less at supermarkets because prices have gone up over the last year. So not sure about this reading. Can be true, might not. And what we see here from the general trend is, yeah, okay, it has come down, but it's also flattening out. Could be just noise, actually. And typically inflation comes in waves. For some reason, it appears unlikely that oil prices will fall dramatically over the next couple of months. So expect a rise over here. And the bond market with the high yields is already pricing that in. While the Fed hasn't moved, capital markets have, especially on the long end. The US 30-year Treasury yields are breaking to highs last seen in 2007, before the great financial crisis. That tightens housing and auto loans and punishes companies reliant on cheap money for massive investments. Reminds you of something? AI? Data centers? Growth and technology, hyperscalers and semiconductors are under heavy pressure, while healthcare, consumer defensive, and real estate now provide support. Real estate has often been an early warning sign for a coming recession, although our recession indicator is currently not signaling a near-term recession. Let's have a look at the economic cycle analysis. Basically, our model says that we are in early expansion, and at some point it makes sense, but it takes into account also the equity markets, and they are on they've been on on recent highs. If you take a pure economic calculation, we see that we have entered the slowdown phase very recently, after being in late expansion, and that makes much more sense actually, since we see a tight labor market basically and relatively high unemployment rate, and a tightening in the housing market cycle due to the high yields. The market is no longer just a Max 7 market. It's broadening. More stocks are rising and making new highs, whereas the heavy-weighted components, such as the Max 7, are dragging the whole index down. In the breadth you can see these are new highs above the daily moving 20 or moving 50 average. So the market somehow is healthy, but the Max 7 aren't. Nvidia. Our analysis chart shows that we had many dark bull trades around the top area, combined with politician sells. Okay, there was a buy, more sells, and insider sells. So this massive top formation is now at the last support level and could easily break to lower lows. Microsoft's chart pre-Q3 earnings now meets fresh news. Overnight, earnings took place. Microsoft beat expectations with strong Azure and Copilot momentum, lifting shares after hours. In the chart, we have to notice that there were many insider buys, so these are politician buys, down at support levels, and some massive dark pool trades over here. Generally, the earnings period is positive for Microsoft, and earnings trades give good statistical results on the long side. Meta disappointed with softer guidance, reinforcing a more selective stance towards mega caps. Attention now turns to today's US Q3 GDP, core PC inflation and earnings from Amazon and Apple, which could determine whether the recent tech correction deepens or turns into another buy the dip opportunity. And if we talk about outlook, rising yields make bonds and treasuries a real alternative to risky stocks. Defensives, they keep holding up quite well, but the tech-heavy Nasdaq leads the losses. A lot of deleveraging has already taken place, especially in the Kospi South Korean market, where we had some dramas, really. However, the oil price represents a persisting risk, and even tweets or fake news cannot recover the fundamentals overnight. For now, the trend is bearish. Smart money indicator points towards lower lows. You can always expect hefty dead cat bounces, of course, and sharp rallies of several percent, which are characteristic of a bear market, so be aware of that, but don't get fooled. The thing is, if the defensives stop holding up, then the whole market will go lower and selling could accelerate. Stay defensive, watch out, be patient. And now let's have an outlook on the current Q3 earnings season. We see that technology is not the only sector that has a good average growth outlook. Even real estate, which is performing quite well recently, has around an average growth of 40%. So maybe it's time to switch from technology to other sectors which could offer very interesting trades. So what's coming up today? We have a couple of tech stocks, Valeo Energy. Not sure if you want to trade those earnings. Monolithic Power Systems, yeah, they offer good statistics, especially after the earnings day, from here to there. An average 9.8%, the typical earnings gap of +3. That could be interesting. What about Apple? So the earnings trade would have started 4 days ago. However, the average performance from today until 10 days after earnings is still +7% with a win rate of 83. Let's check out the Apple trade. It is in a strong uptrend, but we have reached very high levels and rather uncertainty candle has formed yesterday. So I'm not sure if I would like to buy Apple at those high levels, although the earnings performance, which we see here, is still pointing upwards. Could be a trade. Let's see what our algorithm offers. among the best earning trades. So in this table you can sort to find your favorite entry from today onwards, and first Solar is popping up as a stock with very good earning statistics and an upside potential of 28 based on last earning moves. Okay, some of them were pretty good, maybe they're exceptional. You could even take into account all earnings, but we prefer to focus on the current quarter only to take seasonal effects into account. It's summer, people buy solar plants in summer, so the earnings could be better now. And statistically the best day to enter is today, actually, giving a plus 19% and a win rate of 100 based on the very few earnings data that we have. So take this with a grain of salt. A win rate of 100%, yeah, that's only possible if your number of statistical trades is very low. Otherwise you should have also some losers there. So that's the danger, but so far it has always performed well. What else have we got? Exxon. Entry today. The best entry would have been a couple of days ago, but like entering today you still can make an 8% with a win rate of 67%. Use this tool to find all the good opportunities in markets, especially now in the earnings season, and evaluate your statistic edge with this tool. Find opportunities in other sectors, healthcare for example. And use the analysis chart to see whether insiders or big dark pool trades are happening.
For daily, data-driven charts and context, visit Markets in Vitro.